criticisms and misuses of derivatives. Before getting into the specifics, let's recognize the fact that financial markets have cycles. And these cycles include asset bubbles. Bubbles are where asset prices are inflated, or we can say that asset prices are above intrinsic value. The prices are more than what they should be based on fundamentals. And then when these bubbles become excessively inflated, potentially bubbles burst, and then the market crashes. After every crash, lots of studies are done to explain the causes of the crash. The recent example is the credit crisis of 2007-2008. Typically, these reports blame derivatives as a primary cause for the crash. The primary arguments made against derivatives is that they involve a lot of speculation, and in fact, they are so speculative that there isn't much difference between derivatives and gambling. Some people actually say that derivatives are like legalized gambling. This criticism is sometimes taken one step further to say that derivatives cause the overall financial system to be destabilized. Let's look at these criticisms in a little more detail. First, speculation. Clearly, there is some speculation involved in derivatives, but if you think about it, if you have entities that want to hedge their risk, so let's call them the hedgers, they can only hedge their risk if somebody is willing to buy that risk. We need a counterparty. Speculators are the counterparty. Without speculators, hedgers will not be able to hedge their risk. So speculators do play an important part. Generally in society, speculators are much maligned, but if you think about it, there is speculation involved in lots of activities. Even if we buy a stock, we are speculating that the company will do well. If I leave my job and start a small company, I know that most startups fail. So here also I am speculating. Is that a bad thing? Not necessarily. So the point is that speculation is not necessarily bad. Another important distinction between derivatives and gambling is that with gambling, only a few people benefit. In fact, very few actually benefit from gambling, and one might say that overall society is worse off. With derivatives, on the other hand, if they are used properly, then they make the financial markets more efficient, and we talked about that in the previous section. By making financial markets more efficient, society overall benefits. So we can say that derivatives have a broad beneficial impact on society, whereas gambling only benefits a very small number of people. Let us now come to the second argument, that derivatives destabilize the financial system. And this argument does have some merit. Generally, derivatives involve a high degree of leverage. Let's say we have a speculator who is using derivatives and using excessive leverage. This speculator has borrowed from A, that's where the leverage is coming from. Let's say entity A has borrowed from B, and entity B has borrowed from C. Now, if the speculator defaults, what happens? That means that A is in trouble. A doesn't get back the money that it is supposed to. This means that A will default. If A defaults, that means that B is not getting its money, so B defaults, and so on. What you are noticing here is that a default by the speculator impacts the overall financial system, and that is the point. This clearly has happened. Classic examples include long-term capital management. In 1998, they took excessive leverage, and then when they crashed, the financial system was impacted. So, as I mentioned before, this argument has some weight. However, the curriculum points out that the issue with high leverage is not an issue that impacts derivatives alone. There are several other ways in which high leverage can be taken without the use of derivatives, and that too will have the same impact on financial markets. So the larger point is that derivatives are extremely powerful and they need to be used properly. If they are not used properly, then the impact can be disastrous. Another criticism is that derivatives are extremely complex. The financial market often employs mathematicians and scientists to come up with models that try to explain how the markets will operate. These models frequently fail, and then the financial market and those who operate in these markets are heavily criticized. But we need to recognize the fact that when mathematicians and scientists come up with models which try to explain derivatives, what they are trying to do is extremely difficult, because underneath these derivatives is the actions of human beings, which are extremely difficult to model. Now let's take a look at example 6 from the curriculum. Which of the following is not an advantage of derivative markets? They are less volatile than spot markets. This does not look right. They facilitate the allocation of risk in the market. This is correct. They incur low transaction costs than spot markets. This is a true statement. So A is the correct answer. Which of the following pieces of information is not conveyed by at least one type of derivative? The volatility of the underlying. I gave you an example earlier where the price of a call option tells you a little bit about the volatility or the implied volatility of the underlying asset. So this conveys some information and is therefore not the right answer. The most widely used strategy of the underlying, I will mark this. This probably looks like the right answer. The price at which uncertainty in the underlying can be eliminated. I did not explicitly talk about this earlier, but I'll mention it here. Derivatives do allow us to determine the price at which uncertainty in the underlying can be eliminated. And to understand this, let's say that you own a particular stock and you want to buy an option, let's say a put option, to eliminate the uncertainty associated with this stock. Now clearly, if the uncertainty is high, then the put option will be worth more. If the uncertainty is low, then the put option will be worth less. So the price of the put option tells us a little bit about the uncertainty involved. So this is a true statement about a particular kind of derivative. The correct answer therefore is B, the most widely used strategy of the underlying. The derivative itself does not tell us about strategies that employ that particular kind of derivative. So B is the best answer. Which of the following responds to the criticism that derivatives can be destabilizing to the underlying market? Market crashes and panics have occurred since long before derivatives existed. This is actually a true statement. The curriculum gives us examples where crashes occurred before derivatives were used. So if we blame all crashes on derivatives, then that would not be true. A is therefore the correct answer, but let us also look at the other options. Derivatives are sufficiently regulated that they cannot destabilize the spot market. This is not true. At times, derivatives do destabilize the spot market, especially if they are not used properly. The transaction costs of derivatives are high enough to keep their use at a minimum level. This is a completely untrue statement. We now come to the final section of this reading, elementary principles of derivative pricing. Here is the key point. We need to understand the concept of a hedge portfolio. This is a combination of a derivative and underlying such that risk is eliminated. So if this is a hedge portfolio, we have the derivative and we have the underlying. They are combined in such a way that risk is eliminated. If risk is eliminated, then the return must be equal to the risk-free rate. Now, the principle of derivative pricing is that we take the underlying has a certain cash flow and a certain required rate of return. Given that, we combine that with a derivative to get the risk-free rate. What is the price of the derivative such that this combination will give us the risk-free rate? That principle is used to come up with the price of a derivative. This is something that we will see in a lot of detail at level 2. At level 1, you need to understand the high-level principle that I just described. There are two subsections here. One is storage and the other is arbitrage. This point is not mentioned in the learning objectives, but I'll just make a very high-level remark. Certain kinds of derivatives, such as forward contracts, futures contracts, where the underlying is a commodity, obviously require some storage costs. With forwards and futures, we get into a contract at time 0 for a transaction that needs to take place in the future. If you think about cotton futures, there will be certain storage costs. And the point is that the futures contract price or the futures price or the forward price, if you are dealing with forward contracts, need to factor in the storage costs. Those storage costs are sometimes also referred to as cost of carry. And that is all we really need to say over here. This material will be covered in more detail later. Arbitrage. This is an extremely important point. Arbitrage is the condition that two equivalent assets or derivatives or combinations of assets and derivatives sell for different prices, leading to an opportunity to buy at the low price and sell at the high price, thereby earning a risk-free profit without committing any capital. So if we can earn a risk-free rate without committing capital, that's arbitrage. Other arbitrage scenarios are where you don't take any risk and get a return higher than the risk-free rate. So let us take a simple example of arbitrage. Let's say that you have two markets, A and B, and in these two markets, the same stock, let's say stock X, is selling at different prices. In A, it is selling for 51. In B, it is selling for 52. Now, an arbitrage opportunity exists here because the same thing is selling at a different price. You can buy at the low price and sell at the high price and make money without taking any risk. That would be arbitrage. The curriculum describes other scenarios which are a little more complex, but at this stage you need to understand the definition. If you do have a situation like this, then the combined actions of arbitrageurs bring about a convergence of prices. What will happen if everybody is buying over here? The price will go up. What about the price if people are selling over here? The price will come down. So the combined action of arbitrageurs will ensure that this particular stock will be at the same price in both markets. So notice, arbitrage leads to the law of one price, which is that transactions that produce equivalent returns must sell for equivalent prices. In other words, that particular stock must sell for the same price. Let's take a look at example 7 now. Which of the following is a result of arbitrage? The law of one price, law of similar prices, law of implied volatility. This is easy. We've just talked about the fact that arbitrage leads to the law of one price. When an arbitrage opportunity exists, what happens in the market? The combined actions of all arbitrageurs force prices to converge. This looks right. A combined action of arbitrageurs results in a locked limit situation. This is clearly not true. The combined actions of all arbitrageurs result in sustained profits to all. This is not true. There are profits in the short run for the arbitrageur, but then once the price reaches the level where it should be, there is no more arbitrage profit. So the correct answer is A. Which of the following? Next question. Which of the following accurately defines arbitrage? An opportunity to make a profit at no risk. This sounds appealing, but let's consider what is being said. When you invest in a government T-bill, you do make a profit without taking any risk. So this doesn't really look right, but let's put a question mark. An opportunity to make a profit at no risk with the investment of no capital. This looks like a better definition, so let's mark this. An opportunity to earn a return in excess of the return appropriate for the risk assumed. Some might argue that this is arbitrage, but note that we are investing money and we are taking risk. So if we compare this with B, the best answer is B, where we are making a profit without investing any capital. Next, which of the following ways best describes how arbitrage contributes to market efficiency? Arbitrage penalizes those who trade too rapidly. That's not true. Arbitrage equalizes the risks taken by all market participants. This is not true. Arbitrage improves the rate at which prices converge to their relative fair values. This is a true statement and hence the correct answer. Let us go over the summary of the main points from this reading. First, you need to understand what is a derivative. A derivative is a contract which derives its value from an underlying. In fact, what a derivative does is it transforms the performance of the underlying. When the underlying is a stock, for example, and let's say you buy it at a given price, the stock can go up or down. If the derivative is a call option, then the payoff of the call option might look something like this. So the payoff and then the profit from this call option is derived based on the underlying, but it's not exactly the same as the underlying. The derivative takes the performance of the underlying and transforms it in some way. Next point, exchange traded and over-the-counter derivatives. Some derivatives are traded on a formal exchange, and that would include futures contracts. Several options are traded on an exchange. Here the contracts are standardized and the only thing that is not standardized is price. By trading on an exchange, we effectively eliminate credit risk. The other high-level type of market is an over-the-counter market. Swaps and forward contracts trade on over-the-counter markets. These are not standardized and the contracts are custom agreements between counterparties. In terms of types of derivatives, there are two major categories: forward commitments and contingent claims. Forward commitments typically have zero value at initiation. That is because at time zero, a contract is agreed or contract is signed to do some transaction in the future where both parties might win or lose. And these are often structured in a way that the value is zero and the probability of both parties winning, losing is the same. Examples of forward commitments include forward contracts, which are traded in over-the-counter markets, futures, which are typically traded on exchanges, and swaps, which are traded in over-the-counter markets. Contingent claims include options and credit derivatives. The major category that we'll worry about is options. Within options, we can have call options and put options. The idea here is that the payoff is contingent upon some events related to the underlying. If we take a basic call option, then the payoff happens if the value of the underlying is greater than the strike price. And all these things will make much more sense as we cover the material later in derivatives. The purposes of derivatives, the major purpose is to hedge risk. By using derivatives, we can manage our risk without trading the underlying asset. Derivatives also allow us to reduce transaction costs. Derivatives tend to have greater liquidity compared to the underlyings. Derivatives make it relatively easy to do price discovery. And finally, derivatives make markets more efficient. Next item has to do with controversies associated with derivative markets. One controversy or one objection raised against derivatives is that they are so speculative that they are like legalized gambling. The major critique to that argument is that gambling only benefits a few, whereas derivatives have a beneficial impact on the overall financial markets. The other criticism, which carries more weight, is that derivatives can have a destabilizing impact on financial markets when excessive leverage is used. The critique there is that excessive leverage can also be used without derivatives, and in fact, markets have had crashes even before derivatives existed. The final point has to do with arbitrage and the law of one price. Arbitrage is where you can make money or make a profit without investing any capital. If there are arbitrage opportunities, then arbitrageurs will take advantage of those opportunities, and that will cause assets which are mispriced to converge to the correct price. That brings us to the end of this reading. As always, I want you to go over the summary, review the learning objectives. I have covered all the examples, but at some point I want you to go back to the examples and see if you can do them on your own. Do all the practice problems in the curriculum. If you find some problems a little confusing, I would suggest that you come back to these problems after you have done the other readings in derivatives. And if you have time, please practice questions from other sources.